The views shared on this podcast are those of Mike Sowers and do not represent those of Commercial Investors Group. The information shared is not investment advice. Please consult your financial, legal, and tax advisors before making an investment decision.
Well, I got the Superstar Dream Team crowdfund guys in here today. They're fun, and they helped me succeed on the Lowertown Lofts at Station 4 project, and they are thought leaders in the commercial real estate industry. They're going to give you the ABCs of crowdfunding and everything you need to know to at least get started, and give these guys a call. I'm excited to bring you this presentation. There are two kinds of people in the world. Those that worry sharing their ideas will hinder their success, and those who are driven by the success of others. The first kind view everyone as a competitor. They guard their playbook tight to their chest, rarely collaborate outside their inner circle, and are reluctant to show their cards. Then there are the second kind, the kind who have graduated from the first category. They don't count the number of deals they've done. What counts to them is the number of people they impact and the depth to which they impact them. Achievement is still important to them, but it's subordinated to the depth of their purpose. So they give freely of their time, knowledge, and expertise to build a bridge for those who follow in their footsteps. These are the people who were called to change the world. These are the people who develop people, places, and ideas. This is the show where they do it, on the Creative Commercial Real Estate Podcast. Today I got my superstar crowdfund team in here, and we're going to have a riot. Joining me is David Duccini of the Silicon Prairie Portal and Exchange, and Zachary Robbins of Messerly and Kramer. Thanks for coming on the show today, guys.
Thank you for having us.
Yeah, thanks. Really appreciate the opportunity.
All right, you guys got your radio voices ready?
Let's do this thing.
All right, so let's talk crowdfunding at a 40,000-foot view. What is it? Why should we be doing it? And how can the small investor or large investor take advantage of some of the laws surrounding crowdfunding and some of the exemptions in Minnesota? So, Zach, why don't we start with you and kind of the high-level laws, and then we'll drill down a little bit.
And I'm even going to go even a step further back in the history of crowdfunding because it is millennia old. The term crowdfunding is very new, but this concept has been around for centuries upon centuries. And you know, going back to very ancient cities, it's how they funded the building of synagogues and churches, etc. It's how the Statue of Liberty was paid for, and that's effectively by taking small amounts of money from many different people. Now we call that crowdfunding. Zooming ahead to the late 2000s, last decade, Kickstarter launched in 2009 and to date has raised in excess of $5 billion for projects. And that is really what brought crowdfunding to the attention of the public. Of course, Kickstarter is rewards-based crowdfunding, meaning that campaigns launch on that website and the contributors receive a reward in exchange for giving money. What we're going to be talking about today is slightly different. This is investment crowdfunding where the contributors are actually getting a security in exchange, and that security is basically a return on their investment.
Got it.
So in 2012, Congress reacted to a lull in our society due to the Great Depression and fortunately passed the Jobs Act. So the Jobs Act was in direct response to the fact that banks were not lending money and developers and other deal sponsors were having trouble accessing capital. So Congress, in their wisdom, said, hey, Kickstarter is this incredible platform helping companies raise money for projects. What if we allowed companies to be able to do that but sell equity or debt or some other instrument? And so the Jobs Act of 2012 was thankfully a bipartisan bill. It was passed in 2012, and I was following it very closely at the time, and I was super stoked for it to go into action. ... It didn't go into action until 2016.
Okay.
So we had this 4-year period where this incredible thing that so many people were excited about actually didn't go into effect. In the meantime, states one by one took action, and they said, look, if the SEC is going to drag their feet and not actually put together a real crowdfunding system across the whole country, we, state by state, have the power to draft our own unique system. And so in 2014, myself and a handful of other colleagues, we saw that Wisconsin had similarly just passed a state-based crowdfunding law. And at that time, there were about a dozen other states. And we said, well, Minnesota should do the same thing. We asked around, and no one else within the state was really working on it at that time. So we partnered up with the Chambers of Commerce, with the High Tech Association, Medical Alley, and many others. And we proposed a bill, which thankfully was passed in 2015, and that is called MinVest. And through that process, that's how I've gotten to know you, and that's how I've gotten to know David.
Yeah. So what does MinVest do for me? I'm a guy. I need to raise money to buy a property or for my business. What is MinVest and what does it mean?
MinVest fundamentally does three things for you. It allows you to structure an offering to the public, and that offering can be sold online. It can be sold to both accredited and non-accredited investors. And the third piece is that it can be advertised widely. So those three powerful pieces is what glues all of this together, because the previous 80 plus years since the creation of the Securities and Exchange Act of 1933 and 34, since that point, private companies did not have the ability to be able to both publicize these offerings widely, nor did they have the opportunity to generally solicit to non-accredited investors. So when you bring all three of those pieces together, it gives a potential deal sponsor the opportunity to draw up the structure of whatever property that they're trying to put together, hire an attorney like myself or someone else who understands the securities laws to structure the offering, file it with the state, and then once the state goes through it and there's a 10-day period, then they're able to hook up with a platform like David's, Silicon Prairie, where then that platform can be used to facilitate the transaction. And then a third party likely can step in and help out on the marketing side to figure out how we can push this offering on Facebook, LinkedIn, Twitter, billboards, TV, what have you. That's sort of the exciting part here, is that there's so many ways to publicize these offerings, but it's still so new that we haven't even figured out the best way to do it yet.
Sure. So let's take a step back. You mentioned a term, accredited investors. Can you kind of unravel that for me?
Sure. So it's a complicated definition with 8 parts, but I'm just going to focus on 2 main parts, which is for an individual. An individual is accredited if they have income of $200,000 for 2 of the past 3 years, and are expecting the same for this year. Together with their spouse, that can be reached up to $300K, or a net worth of $1 million excluding the value of their home. That's the definition of an accredited investor. There are many people out there who have problems with it, and we don't really need to delve into that today. Does it need to be updated? Absolutely. I mean, having a test that's purely based on income or wealth and doesn't factor in knowledge or sophistication, I think is a big problem. Certain estimates are there that there are somewhere between 3 to 5% of the U.S. population qualifies as accredited. The problem is, of course, the other 95 to 97% has basically been foreclosed upon participating in investment offerings for decades upon decades. And so when we have this income inequality, which we do have in this country, this wealth gap, the accredited investor definition only perpetuates that.
Gotcha. Let's talk about the SCORE laws. How are those different than the MinVest laws, and what does SCORE stand for?
Good question. SCORE,
that's the one we used, right?
Correct, yeah.
Okay.
So SCORE is a sister law of MinVest. It's actually been on the books for decades. It stands for Small Corporate Offering Registration. And what David and I call SCORE is that it's MinVest before the internet. It didn't contemplate the internet. It was literally drafted before the internet went widespread. And so it is a mechanism to raise money publicly, but the nuances of it just doesn't quite contemplate all the various different things that the MinVest law put into it. For instance, the MinVest law specifically allows for a broker-dealer or a portal to facilitate the sale of the securities through an internet website. SCORE does not mention anything like that. So what we did is in 2017, when we made amendments to the Minvest law, we included SCORE in it. And so we basically said that any SCORE offering can be sold on a Minvest registered portal like David's. And so that way we sort of glued both laws together and we're able to basically breathe new life into SCORE. And why would we want to do that? Because in 2016, the SEC changed the definition of Rule 504. And I know we're sort of getting in the weeds here, but it's important because Rule 504 is the main mechanism for how companies would raise money from private investors. And that is non-accredited private investors. Okay. And 504 was capped at $1 million. But in late 2016, that was bumped up to $5 million. And so for us who are helping different clients with their investment crowdfunding offerings, depending on the size, if we need to surpass $1 million or $2 million, SCORE starts to make a lot more sense. The second point, though, is that SCORE is actually technically a multi-state law. We need to figure out the exemption in each state, but Minvest is strictly Minnesota-based. So those are some of the distinctions.
Gotcha.
One of the other key distinguishing factors of the SCORE offering is that the limitation on non-accredited investors is subject to what's known as suitability. So whereas Minvest makes it very easy to raise money from Minnesota residents, non-accredited investors can invest up to $10,000 per offering per year. The SCORE, having been around quite a bit longer, doesn't contemplate those limits per se. And instead, that's how it makes sense, especially when it comes to real estate, where you could potentially have a non-accredited investor who wanted to invest a significant portion of their assets into real estate projects. And so the SCORE offering might make a lot more sense. Now, one of the things that's interesting about it is because it is so old, it has a lot of friction. There's a long form that's been associated with it, and so there just haven't been that many offerings. But one of the things that we've done working closely with Zach is that we've been able to sort of automate a fair amount of that paperwork so that we've taken the friction out of doing those offerings.
Yeah. Didn't we get the quickest approval ever?
Pretty much anywhere actually in the U.S. I did do a check with a guy that tracks these things, and it's really unheard of. In fact, I think it beat any Minvest offering to date. Minvest has a baked-in 10-day window. SCORE has no such service level agreement, and your offering got approved in like 3 days. It was just dizzying.
Superstar. You guys are superstars. So let's just do a quick firing round here so that our listeners can really understand. So let's start with what is the grand total limit for Minvest and SCORE. Let's talk about the limit per investor, and then what is different between accredited and non-accredited for each one, and how does that impact anything?
Sure. So Minvest is capped at $2 million. If you're going to raise between $1 to $2 million, you're going to need to provide audited or reviewed financial statements. If you're going to raise $1 million or less, you can rely on internally prepared statements. Minvest has a cap of $10,000 per non-accredited investor, whereas accrediteds can invest as much as they want. SCORE, you can raise up to $5 million. There is a audit requirement, and that's in the statute. But then in the regulations that accompany it, there is an exception for the audit, which we typically rely upon so long as we can meet that. And there is no cap on how much a non-accredited can invest under SCORE.
Okay. And was that's like basically if you don't have historical statements to audit?
Yeah, it's not in front of me right now, but there's an exemption under the regs that basically allow most offerings to get away with not having to do a full audit. Why is that important? Because audits can cost in excess of $10,000. They take a tremendous amount of time. And to your point, if it's a startup company or a startup shell entity that we are creating to purchase a property or renovate a property, there's nothing to look through in the past. So it just doesn't make any sense.
So $2 million in Minvest that requires an audit, but up to $1 million without an audit?
Correct.
Is that okay? So let's just say equity requirement is 25%. So we're talking Minvest. I can get up to $4 million total because I can leverage these funds as well, correct?
That's an excellent point because oftentimes we're approached by deal sponsors who say, I don't think crowdfunding makes that much sense because our deal is, a $10 million deal or it's a $20 million deal. And we say, hold up, we can raise just the equity piece via crowdfunding. And so if you're doing a $20 million deal and, 25% loan to value, then we can raise up to 5 and you can have your equity component to it and get the rest via debt. So that's an excellent point.
Yeah. Good. David, anything you want to add on kind of the nuances, specific real details that people need to know? I know for me, I think the biggest challenge for the Minvest was non-accredited investors capped at the $10,000.
Yeah, that certainly is a limiting factor. One of the things that's interesting is that in places like Wisconsin, which were a couple years ahead of us, they've actually created a new definition called a certified investor that we're hoping to bring to Minnesota here sometime in the next year or so. But that changes the definition to someone who makes $100,000 or $150,000 with a spouse and has $750,000 of equity or net worth, including their primary residence, which we think is a much more rational definition. But one of the beautiful things is that because Minvest is a relatively low doc filing offering, they're relatively easy for us and direct for us to file if you have your financials put together and your business plan use of funds. The score offering, now that we have essentially automated that, it makes it a much more preferred route potentially for real estate because of that. There's no limit on the non-accredited investors. And to that point, one of the things I'd like to point out is that you can use self-directed IRA funds as an investor to invest in these projects because they're real financial securities. And so while you may not have, $10, $15, $30, $50, $100,000 to invest in your friend's real estate project, you could use a self-directed IRA tax advantage, through a platform like ours to make those investments. And we have seen, significant amounts of capital flow from people using those self-directed IRAs.
Yeah, that's huge. I think like 8 out of 10 of my investors were using self-directed IRA stuff. We've been talking to David Duccini and Zach Robbins, and we'll be right back on the Creative Commercial Real Estate Show. Today's show sponsor is National Property Inspections. Steve Quint is my guy. He does all my commercial inspections in all asset classes: industrial, retail, office, and multifamily. Steve's the best of the best here in the Twin Cities. What I love most about him is he goes the extra mile to give me an itemized one-page list of all the major renovations to be done and the cost associated with them. He even gives me a list of all the mechanicals with serial numbers, model numbers, and expected remaining useful life so that I can plan out my annual budget for capital expenditures. If you want a free quote from National Property Inspections to inspect your next investment, call or text him directly at 612-242-4568. 612-242-4568. I guarantee that you're going to be happy with the results. You're listening to the Creative Commercial Real Estate Show. I'm Mike Sowers, your host, and we are back with David Duccini and Zachary Robbins, and we're talking about crowdfunding. Let's talk about out-of-state investors. What are the differences between the two exemptions? Is that what you would refer to those as, exemptions or laws?
Yeah, technically SCORE is a registration, not an exemption, but I mean, this is all sort of semantics here. So out-of-state investors are best taken care of in the form of a private offering that we do before doing the investment crowdfunding round. So typically we'll do a friends and family round limited solely to investors that the issuer has a substantial pre-existing relationship with, and we will typically bring in those investors at a discount. So, that makes sense. These people have known the deal sponsors for some time, and so if they're coming in at a 20% discount or a 15% discount, we will put that in a private offering in a defined period of time. We'll say, all right, you have until the end of March to invest. And certainly don't have to. We would love for you to join in this private round. Keep in mind, though, on April 1, the round's going to go up. Instead of 75 cents a share during this private offering, it's going to go up to $1. And so that's a great way of raising money from folks outside of the state. We're technically using a different exemption that's typically done under Rule 504 or 506B. And we then close up that offering, and then we go live with a Minvest offering, a score offering, or a third option is Reg CF, which stands for Regulation Crowdfunding, which is the federal version of Minvest.
So if I got a bunch of, let's say, California or Florida money, and they want to get into a deal, you would recommend that I do actually 2 rounds of offerings?
That's right, and it sounds very complicated, but we end up using nearly identical documents for each round. We obviously do have to make tweaks to the documents because the deal terms are going to change, but yes, that's exactly what we're doing. We're doing a private offering to, quote, friends and family. These are people, again, who have a substantial pre-existing relationship with the deal sponsor. Then we quickly shut down that round, and then we open up to everyone, where the prospective investors don't need any relationship whatsoever with the deal sponsors.
Yeah, that makes sense. So under SCORE, you can do out-of-state investors as long as you have a pre-existing relationship. Is that my understanding?
So SCORE, so what we would typically do is do a private offering, and then we would go into SCORE. And so if we can get in investors whom in that private offering beforehand, that's beautiful. If we don't, yes, we can find a SCORE exemption in most states. The issue is that it gets costly to figure out, hey, are we meeting the requirements of North Dakota, Minnesota, Wisconsin, Iowa? Every state has their own nuances and tweaks, and so it can get costly to ensure that we are registered in each state. So that's why it's often better to find a different exemption.
It also depends on familiarity too. So because the SCORE has been on the books for a long time and there's been so much friction, we did a survey in the 5-state area recently, and so Minnesota led the way with the highest number of scores. Iowa had 1 score in the last 5 years, and Wisconsin hasn't done any in the last 5 years. And so we did have conversations with the regulators, and they are, one, comfortable with us potentially doing a score on the portals where we're approved in those states. And then, typically what you do is you will file in your home state and then petition to make it get effective. Again, there's no service level agreement, and there's no guarantee that the regulator won't sit on it for a while.
Sure. So let's talk best practices, David. And tell me a little bit about the portal process and how that works.
Yeah, for sure. That's a great question. So first thing you need to do is decide that investment crowdfunding is right for your particular deal, right? You have a lot of options when it comes to raising capital. You can do it from friends and family. You can do traditional. You could do an SBA. You could go to a hard money lender. We think that this process could offer some significant competitive advantages, especially for that hard money lender.
Let's talk about that.
Yeah. So instead of coming to a hard money lender and slap it down 5 points, to get your loan, and then paying, anywhere between 9 and 15% interest for 6 to 9 months or a year, you could pay that interest to your friends, right? You could come in, to the portal, go to your registration, get it effective, and start soliciting. It could be a pure debt-based deal, and you're just going to pay back interest. It could be a revenue share on an income-producing property. That's the beautiful thing about the exemptions here, is that you have total control over what you're selling.
Are you required to do even one of these filings if it's purely a debt instrument? Because they're viewed as opposing parties?
So if it's a debt instrument with a commercial bank, then no, because that is exempt from the definition of a security. But yes, if you and I enter into a debt relationship and you want to utilize crowdfunding laws, then we would need to make that filing. Whereas if you and I just want to enter into a borrower-lender relationship, and it's just a private transaction, we could rely on the private placement exemptions of Rule 506B or 504.
Because my understanding was that if I go to David and he's a buddy of mine, and I say, hey, give me $100,000 to do this deal, that I don't have to do any filings because it's a debt instrument. But if I go to him and I say, hey, let's do a joint venture, we can also just hire an attorney, create an operating agreement, and do that deal. So when do you cross over the line and need to do this?
Yeah, so it ultimately depends on whether or not there's a security being sold. And so I think there's a certain myth out there that debt doesn't qualify as a security, but in fact it does. If there is a return on the investment expected and the investment is being made into a common enterprise where there are profits to be expected from the work of others, then you have a security. And so debt meets that definition. Despite not having the major upsides that equity often has, debt does qualify as a security.
Good.
So some of the best practices that we really socialize is once you've decided that crowdfunding makes sense for you, you pick a portal, we partner you up with a securities attorney, and then we go to work on helping you collect your paperwork, your business plan, your financial documents, and then taking kind of a stakeholder-based approach, figuring out who does well when you do well, right? Who in your ecosphere, potentially, subcontractors, besides friends and family, where's the money going to come from? We basically say, try and find the money on paper first instead of, posting and praying, right? So it doesn't really work well if you just put your thing on the website and hope that it's going to rain money on you. That's kind of a myth, right? At the highest level, investment crowdfunding is just like any kind of fundraising. It is the slow conversion of your social capital into financial capital. Whether you're selling Girl Scout cookies or you're raising funds for your next, multifamily tenant property, right? You're going to first initially tap the people that you know. The first money that comes in, they always know you. The second money is the friends of friends, and then if you're really lucky, the third wave of money is the network effect, right? The people that are going to bet along with the crowd. That's where you get the random strangers you never met that think, hey, looks like a good deal, looks like it's going to close soon. That FOMO, that fear of missing out kicks in, and that's when the crowd really gets excited.
I had one of those guys.
Amen.
Good. Talk about your portal and how you guys are synchronized with Alto IRA. So I'm going to raise money from friends and family. Let's say they're all tied up, but a lot of them are working corporate jobs.
Sure.
They might have an IRA.
Yeah.
How easy is it for them to get into one of these deals with the way that you guys are set up?
Yeah, it's amazing. This really goes to, so we've been actually on a tear for the last 5 years trying to figure out how to get the friction and costs out of doing self-directed IRAs. And so if you've ever done one before, you know that the cost can range from, as little as a couple $1,000s on up to, $5,000, $6,000, $7,000, $8,000. And so we found a fintech, a financial technology company called Alto IRA, that are, really rock stars in the space. And so they've been able to just laser focus on this, become a custodian for themselves, built an automation platform that allows investors to come to our site, decide they want to invest in a real estate project. They can set up a self-directed IRA for as little as $49, flow your money over from your existing custodian. So a ton of millennials out there have several abandoned baby 401ks from job hopping, right? You have $25,000 here and $35,000 there. And so you can tap into those funds tax advantaged. Alto makes it seamless. They'll flow the funds over, and then they'll go right into the escrow account for the campaign company.
Yeah, that's super cool. So how do I decide if this is right for my business? Any tips on that?
Yeah, that's a great question. So you look at really fundamentally the cost of capital. What is the cost of capital? And, really to some extent, how fast do you need the money? So investment crowdfunding, again, that slow conversion, the first time out, right? It might take you, 30, 60, 90 days to close on that funding. And so a lot of times, it might make more sense to pair that up with traditional, commercial lending or an SBA. The beautiful thing is with investment crowdfunding is that you could potentially avoid personal guarantees. All SBAs have personal guarantees associated with them. But once you get rolling, if you're going to do multiple deals, you're going to kind of build that network effect yourself. And so, if you're showing good returns, whether it's income producing or you've done some fix and flips, I believe that you're going to have a much easier time tapping into that into that friends and family network, and then the friends of friends are going to come along when you start to see that these deals are legit.
I would just add to that it also depends on the specific deal type that we're talking about. If you're going to raise money for an industrial property, that may not have any sexiness or attractiveness to the public and may not make any sense for investment crowdfunding. Whereas if you're going to raise money for a mixed-use property, retail on the bottom, commercial on top, and it's in a desirable part of town, that could be an excellent deal to crowdfund. So to a certain extent, it depends on what the use of the property is to determine if it's going to make sense to crowdfund or not.
Well, on that note, what does the timeline look like for this deal? I mean, traditional commercial deals, 30 to 60 days due diligence, 30 to 60 days to close. So we're probably 2 to 4 months total time frame. Is it realistic that we're going to be able to crowdfund something like this?
Typically, we ask for a longer period of time. However, it's not impossible to do it within that time frame. It's just incumbent that if we have a tight schedule, that we have a game plan fully laid out and that we are executing appropriately, because there can be many bottlenecks in the process. And if one of those bottlenecks holds us back 1 or 2 or 3 weeks, then it could take that whole time frame out of scope.
So walk me through the kind of statutory time frame and then what you're seeing for real time frame. So step one, I decide I want to do it. I call you based on the number here that we're going to have at the end. So I decide I want to move forward, and then I call you to do a deal. So what happens next?
Typically what happens next is we're going to ask for an LOI or a PA to determine what the status of that deal is. The last thing we want to do is go out and crowdfund for a property which the sponsor really doesn't have locked up yet. That can just be a very bad look. So we just want to make sure that there is some credibility to it. And then the second step is ensuring that there is a bank or other lender on board who's provided either a binding or a non-binding term sheet to provide the debt capital that's going to be needed. Next step after that is business plan, which is going to show everything from what the future property is going to look like to the prospective tenants to the prospective financial projections. From there, once we have all of those items, then the ball's in my court to start drafting legal. But you and I are going to put our heads together, and we're going to first figure out on what that structure is. Meaning you're the sponsor of the deal. What portion are you keeping? How much skin are you going to have in the game? What are the corporate governance rights? Meaning how are decisions made? Is this purely passive, or are the investors going to have votes on the deal and how the company operates? What do the distributions look like? Both liquidating distributions once the property is sold and non-liquidating, meaning ongoing distributions for that property. Is the entity going to be an LLC, or is it going to be a corporation? So these are just some of the major questions that we need to tackle up front, and I put that in a document called the Summary of the Offering Terms, typically anywhere from 2 to 5 pages, and that is at around 20,000 feet going to tell the investor the deal that they are investing in, what they're getting themselves into. Once we have the summary of the offering terms, then I'll put together risk factors, which basically tells the investor every reason why they should not invest. Now, for a sponsor, this is counterintuitive. Why would I ever want a document like that? Well, it's a CYA. It's going to cover your behind to ensure that if, God forbid, the deal blows up or the investor somehow, there's a miscommunication and
floodplain or right.
Who knows? And so having risk factors that appropriately tell the investor all the things that could go wrong, at the end of the day, if they try to come after you, you hold out that document and you say, did you review this document front to back? In addition, we have a document attached called the subscription. And the subscription is where the investor is actually saying, I, Zach Robbins, subscribe to purchase 10 units at a cost of $10,000. And there are substantial representations and warranties in that document. That is an investment contract. And again, that's telling me as the investor that there is the risk that I'm going to lose all of my money, that this is illiquid, meaning I can't just get out of it tomorrow. It's not like a publicly traded stock. And that there's other substantial risks involved.
That makes sense. So obviously one of the biggest advantages of this is using some of these other things like Minvest and Score to reduce the cost because of the elimination for a lot of the admin stuff. Not to tie it anything, that's the last thing I want to do, but I know regular SEC filings can be upwards of $50,000 just in legal, so it really doesn't make sense for the small guy, and I think that's why these laws were created in the first place, right? It's so that the small businesses can participate. So can you guys give me an idea what it would cost, just a range to be on the portal, and what kind of legal work for a typical offering?
Sure. I can first answer that. For a Minvest offering, I quote people at $7,500. Which is typically way below where you're going to find any PPM, a private placement memo out there. I'm only able to land at that cost because I work with David. And David built an incredible system called Geppetto, which basically took all of my documents, turned them into software. And I mean, it took us many, many hours, but we put in variables in all of the documents, which we then try to build up front with the prospective deal sponsor. So in short, it speeds up the time it takes to put together the first draft of documents. There's plenty of customization and time that it still takes, but that's how I'm able to land at that number for a Minvest offering. For a Reg CF offering, I typically quote $10,000. because the stakes are that much higher since it's federal and there's different documents required. For a score offering, due to the length of the 118 question Form U7 and the fact that we're likely going to build a PPM with it also, I quote 12,500. For a Reg D offering, I typically quote close to 15,000. Reg D is if we're selling to accredited only investors, whether it's private or public. So that's just big picture what I tend to quote for these different types of offerings. Obviously, it can differentiate depending upon the complexities, but that's the quotes that I typically give for legal.
Good. Appreciate that.
The first one's always the most expensive, right?
Indeed.
I mean, if you do a bunch of these, I'm sure you could probably lock him up with a bulk rate, or on an annual basis. I mean, the beautiful thing is that with our smart document system, we have literally the ability to go in and change a name, change an address, and recreate the entire stack. And so if you are going to do very similar, like once you figure out what kind of style of investment crowdfunding you want to do, again with scale and automation and repetition, right? We think you can get your cost of capital down. Right, so maybe you should have a punch card or something like that.
There you go.
A 6-pack, something like that.
Frequent crowdfunder.
Exactly,
program.
that's right. Yeah, exactly. So on the portal side, it's really pretty simple. So in Minnesota, we can only charge fixed fees at the moment. So we charge $2,500 for onboarding. That gets you 10 hours of consulting where we sit down and help you design your campaign. This is as much a marketing effort as it is a financing effort.
Sure.
And then it's $2,500 to publish, and you can raise up to $5 million on our platform. And that does include free access, essentially, to the Alto IRA platform. You're going to pay $49 to them separately from our side. So we manage essentially the entire process, soup to nuts. That does include your escrow account, which can typically cost as much as $3,000 if you went to Sunrise Bank and got it yourself directly. So because we have all the automation in place, they actually cut us a special deal that we can just eat the cost on the escrow account for you. So. And then in places like, under other exemptions like Reg CF, we are permitted to charge a success fee, so it's $2,500, and then typically 5% of the cash raised under Reg CF up to $1 million is what you can raise there. And then we are an approved portal in Wisconsin, Iowa, and Michigan, where we also can charge a success fee. So $2,500 to start, and then 5% of the cash once you hit your minimum. And so we can be a little more flexible in other geographies and under other exemptions.
Good. So can I raise funds for, can I raise $1 million just into a blind fund and then kind of pick and choose what I want to do out of there?
The way that the law is designed, it does not look favorably upon raising capital in a blind pool. So I would tell you no. However, if you had a really narrowly determined fund, meaning we're only going to invest in single-family housing within the city of Minneapolis, that may be specific enough to meet the muster of the state.
Interesting. So let's say I only want to do value-add projects that are, 30+% vacant, under $2 million properties that are warehouse buildings between 10 and 30,000 square feet in Hennepin County. Is that specific enough?
That sounds pretty specific to me. So there's two questions here, though. We're talking about the legalities, and then there's the practicalities of it. The practicalities of it are that it's hard to raise money for a fund, especially for folks who don't have a really strong track record in the fund environment. That doesn't mean that it's impossible, but investors typically get much more excited about a specific deal. It's something that they can tangibly see and touch and get excited about the tenants. When you're trying to raise money from an investor, especially if they're not super sophisticated and you're selling them on a fund, it's much harder to do so.
That makes sense. So I decide I want to do this. First step's get a PA, and then I need to get a term sheet from a bank. Now, one of the issues that we ran into on mine is the personal guarantee issue. Let's say the bank requires 25% down. They still want to see that the general partner, the sponsor of the project, the person who's actually going to execute the renovation, the lease up, and the ongoing management, or oversee parties that do that, has a lot of skin in the game. So what have you guys seen, and do you have thoughts and advice on that? We ended up having to kind of restructure our deal as a mezzanine debt piece, and they still wanted a minimum of at least in my case, 15% down out of my pocket.
I would add that we've done a handful of deals where the equity raise has been closer to 50%, and then it's been a non-recourse loan. And so Obviously, that's not possible for every deal, but to the extent that it is possible to raise more equity and then get a non-recourse loan from a bank, that's a really nice way to package it up.
Okay. So that's kind of some of the ways around that versus
Right.
doing a high leverage 75% loan to value type of deal.
Yep. The other alternative is if you can find a guarantor, which is a possibility. I've put together those types of transactions in the past. It's just tough to hunt down those people, and they often take quite a bit of chunk of change.
Can you have the crowdfund people individually guarantee it as part of their subscription?
Really creative idea. I'd highly recommend against that.
Yeah. Why is that?
Having a crowd of people who may not understand what they're getting into, signing a personal guarantee with the bank just sounds like something that could backfire pretty easily.
Yeah. I was playing devil's advocate. Perfect. So I decided I want to move forward. So you actually helped me think through. That was one of the things that I thought was really cool in ours, kind of thinking through how many shares and whatnot. So that's obviously all included, and that's probably the hardest part of the whole thing, in my opinion, is figuring
deciding
out
what you want to sell.
is your
right?
offer.
Yeah, what are you
gonna
actually
be,
selling?
right?
Yeah.
And thinking about, what's the marketability of what you're selling? Like, would I buy this myself, and how are you going to sell it? So that's a big piece of it. So how long did it take us to do the first piece of it there once I said yes?
I forget how long that piece took. I mean, geeking out, that's sort of something that I really enjoy. I've started up plenty of businesses in my past. I was in investment banking for some time also. And so sitting down and being able to sort of structure the deal and figuring out what equity piece we're going to keep and what other rights and preferences are involved, and then mocking it up in Excel, it's fun. But to your point, at the end of the day, it needs to be marketable. We can put together the best deal for the sponsor as possible, but if it's not attractive enough for the investors, i.e. the valuation is way too high, then the crowd's not going to invest. And then we're going to have to go back to the drawing board. What does that mean? We're probably going to have to pause the offering midway through, which we've done many times before, and change up the terms, saying, hey, instead of $1 a share, it's now 75 cents or 50 cents. And so investors are now gaining much more equity. There's other more creative ways of doing it also, where you can accelerate profits going back to investors. You can give them a preferred return. You can give them a board seat. So there's a lot of ways to spice up a deal that, when launched, may not have been attractive enough to close.
Yeah, ours is cool. We did the more money you put in, the farther your money went, I think, right? So we did different tiers. You got different preferred rate of returns.
Yep. Very creative way. In fact, I've done deals like that on the affordable housing side as well. And so to the extent that you can incentivize people to invest more, it obviously makes sense in the end.
Yeah.
Yeah, that's really like a twofer, right? So just like you see with like the rewards-based crowdfunding, those perks, right? We call them, right? People like to, especially, and it's been a natural in crowdfunding for things like breweries, right? You can give away free beer. People love that, right? But anytime you can give someone, the sense of, a perk, right? Let's say you've got a building that has essentially like a party room, right? You could, in theory, grant them rights to use that party room, right? So if somebody's going to have a wedding someplace, they're going to have to host it someplace, right? So there's a number of things you could do to kind of sweeten up that, the deal for the use of, right to use.
Interesting. Got the gears turning here again. So timeline, I keep going back to that because that's so critical, because what is it, a week, 3 days? How long does it take to structure the deal? What do you think realistically? First step.
The first step is assuming that we have the PA or the LOI, and we have a bank LOI, and we have a business plan from the from the deal sponsor. I can work as fast as 1 week is the fastest I've ever done one of these offerings. More likely, giving me 2 weeks is going to be better. Sometimes these deals take up to 4 weeks to fully figure out and draft all of the documents.
Yep.
Once we file with the state under Minvest, the state has 10 days to get back to us. Under SCORE, we made a filing last summer, and it was right around sort of the July 4th time frame, and it took them about a month to get back, which was very challenging.
Yeah.
So long story short, once we have the state's approval, though, whether it's 10 days or less or more like 2 weeks, then we need to hit the ground running. We need to be able to raise as much capital as quickly as possible. Why? Because for these deals, we need momentum.
Right.
Many of these deals, they stall because it just looks like the sponsor has, sort of lost all of their air. And if that happens, it's really hard to get it re-engaged and back going again. And so, statistically speaking, about 50% of these deals close, 50% fail. In my opinion, it's not directly linked to the likely success of the deal ultimately from a financial perspective. It's more closely aligned to whether or not the sponsor of the deal can market it appropriately.
Correct.
And so on many of the deals that have failed, the sponsors have been scared to publicize it. Sure, maybe they put up one Facebook post to begin with and send one email out to friends and family, and then that's it. And David and I are knocking on their door and we're saying, hey, we put a ton of time into this. We want this to close. This looks poorly upon us. And we hear, oh, I'm working on it, or I'm going to hire this third party. But more often than not, if we're hearing that from someone, it means that they likely don't have the confidence to follow through on it. And that's a big problem.
Sure.
We typically say that you want to have at least a warm yes from about 30% of your minimum raise. Okay. So before you launch. So when you go to launch, you call them up and you ask. That's, we get that momentum when you go to launch, right? Getting to 30%, if you can get to 30% of your minimum raise, you're gonna hit, to the high 80 percentile. You're gonna hit your minimum raise if you get that first 30%, right?
Yeah, and how long should we set the timeline to raise? 30 days, 60 days? What do you recommend?
It totally depends on what that minimum is. So we can have a maximum of, say, we're going to raise $5 million, but depending on what that minimum is for us to be able to execute, if that's $100K or $250 or $1 million, we're going to need to figure out what the minimum investment is per investor, i.e. how many investors we are going to need in total. Is that 10, 20, 30, 40 to be able to close on the minimum? And so we can sort of work backwards to figure out how long that might take. Generally speaking, for deals in the six figures, you're going to need at least 30 days. For deals in the seven figures, you're probably going to need at least 3 months to raise that much money.
Okay.
That's why we say find it on paper first before you don't even
Sure.
Post it.
So the challenge, obviously, is using one of these to buy a $20 million building. It's what seller out there is going to give you 6 months? We got a month for the paperwork, a month for approvals. We got 3 months to raise the funds, another month to get the bank loan, tidy it up and actually close the deal and have people fund their accounts. I found getting the pledge is one thing, and getting the money in the account, especially with the self-directed IRA. Sometimes there's hoops, not on the end of Alto, but on the actually dispersing IRA, and the loopholes you got to jump through there. So would this perhaps be a better approach for either smaller projects or, hey, I want to do a value-add deal. I want to buy a property and I want to renovate it. Maybe we use other sources to purchase the property, and then after I own it, then I start doing a crowdfund to raise the renovation capital.
Yeah, that's certainly one way of going about it. I would caution, though, that it's not so much the deal size, it's what portion of the deal the crowdfund is making up. Meaning, we like to work in this world that we call patchwork funding, where we have private capital coming from non-accrediteds, we have private capital coming from accredited investors, we have maybe an institution lined up, we have a bank lined up, and then we have the crowdfund. So the crowdfund may only represent 5 or 10%. Having said that, it's an excellent way to gain awareness and attention for your product. So I think to answer your question, it depends on what piece of the project the crowdfund actually is. And so we like to work backwards, meaning we first find out how much money the sponsor is going to put into it. Then we find out how much capital we can get from friends and family. Then we can find out how much we can get from a bank. And then we look at, TIF money and economic development dollars and, like St. Paul's STAR program and anywhere else that we can access capital.
Opportunities, right?
And then the very last thing is the crowdfund money. And so it may be a $5, $10, $15, $20 million deal, but the crowdfund may only be a small sliver of that.
Yeah, that makes sense. So we'll have to kind of wrap things up here. One of my kind of final questions was financial advisors, very well connected. Can these be sold through financial advisors through your portal, and can you pay commissions on that? How does all that work?
So typically, it's an excellent question, a question we get very often, and the answer lies in the compliance department of that financial advisory firm, whether or not they will allow their advisors to sell a a security that is in the form of a private placement? And more often than not, the answer is no. They're not going to allow it. And so there's natural friction then, because the financial advisor doesn't want to give up money that they can no longer charge for their assets under management. So that's why working with a self-directed IRA like Alto is the solution here, because unfortunately an advisor is disincentivized from putting their client in these deals.
Yeah, that's always a challenge. I think if you can unlock the key to that, if somehow you can, because a financial advisor inherently wants to do what's best for their client, and if they don't understand it, they say no. And especially if their compliance department says no, then it's definitely a no. And things like real estate and investing in businesses, somehow now the narrative of Wall Street is that these are alternative, quote unquote, investments. And I always laugh about that, because you think 500 years ago that investing in stocks and bonds for something you can't touch, feel, or don't understand, that feels more alternative than kind of the stuff that's been around forever. I'm going to invest in your business, Mr. Neighbor, or I'm going to invest in a piece of real estate that you run your business on. So, I think you guys are really thought leaders in the industry, and I really appreciate all the hard work that you guys are doing to keep trudging forward in the industry and doing the good work. We had a successful crowdfund using your stuff. We just closed down the renovation loan, in fact, on Monday.
Congratulations.
Thank you.
Congrats.
And Royal Credit Union, I'll have to give them the thumbs up on that. They did an awesome job. I actually have my lender coming in here on the show next week, and he's going to be talking about how the bank feels about these things. So
awesome.
I'll be sure to send that episode out to you guys.
Appreciate that.
Final thoughts that I have for you. I'm going to start with you, Zach. If you had one day left to live, how would you spend it?
Oh, good Lord. I would spend that with friends and family, as cheesy or trite as that sounds. At the end of the day, while I get so much satisfaction out of the work that I do, ultimately friends and family are the two most important groups.
That makes sense. David, who is your number one mentor, and what is one thing you credit them with teaching you?
Oh, that is a toughie. I got to name a number one mentor.
A top mentor.
A top mentor. Okay. Well,
Don't want to paralyze you there.
right. Exactly. Yeah. Well, the thing is, I love really like reading, aphorisms, from the, ancient knowledge, the Greeks and, philosophers. Again, these are probably anonymous, and so that'll maybe save my biscuits. But I love the sentiment that life is rarely either or. Right, so a lot of times people will try to force you into this false dichotomy to make you choose. Right, I guess in that sense you could say that's been best summarized by Rush and Geddy Lee, that if you choose not to decide, you still have made a choice.
That's good. Well, you guys have been a blessing on my life and really helping me get this deal done. And I just want to say thank you for that. And if people want to find you guys, where do they find you?
Best way to find me on Twitter is at ZJRobbins. That's ROBINS. It's the easiest way to find me, and happy to, have a phone call, meeting, email from that point.
And we're on the web at sppx.io, Silicon Prairie Portland Exchange.io.
Thanks a lot for coming in, guys.
Thanks
Thank
for
you,
having
Mike.
us. Appreciate it. Cheers.
Thank you for listening to our show, Creative Commercial. Head over to our website at creative.realestate or find us wherever you listen to podcasts. And please, if you like the show, leave us a review. It really helps us out.